have done the basic configuration of the treasury. So these are the configuration steps what we have completed until yesterday. Okay, so in the 2 sessions we have completed at the same time, even we have discussed detail. Okay, what is the purpose of the this step and why we would require. Then after that, moving to the today, I'm going to start the. Okay, so I'm going to start today money market. So before going to start today's session, if anyone has other query, so please let me know. Okay.
We cannot see the screen though. If you're sharing a screen.
No, what about others? Anand and Shankar?
No, we also not.
Can you able to see?
No, not able to see, Vijay.
Still not at task.
Okay, yeah, let me. Is it visible now?
Still no.
No, sir.
Okay, one moment. Let me rejoin.
Yes, you can now.
Okay, okay, fine, great. Okay. Now, let us continue about the money market. So what is the purpose of the money market? Let me give about the background of the money market. Okay. So the money market, the instruments. First, let me describe here the instruments of money market. Money market can be used for. Please, this is the one of the interview related question, or also the answer also. Okay, remember, money market can be used for short term investments, short term, mid term investments, short and mid term investments are or I'll make you people also can admit. Okay, fine. So here I just mentioned short mid-term investments. At the same time, short mid-term borrowings also. Short and mid-term borrowings also. Okay. So according to our business requirement, we are going to, if we have the excess funds in our organization, then we can go and invest. If we have a surplus funds, we can go and we can borrow the money from the market. But before going to either short-term investment or mid-term or whatever it may be, either investment or it could be a borrowings, how we will come to know. So that is the reason before going to start treasury, I have completed the cash and liquidity management. Okay, so the cash manager, what he does, every day he will monitor the cash positions. Okay, we have already seen how the transactions are going to flow based on the current day statement and as well as the prior day statements and as well as based on the liquidity transactions. So based on that cash view, in case if you find excess funds in his list, in his cash flow analyzer report, he will call to treasury department. So before going to call to the treasury department, he will also discuss with the accounts payable team. Okay, because they have to maintain sufficient funds to run the business. Then once it will be done, then he will inform to treasury department. Okay, now we have excess funds until maybe until one year of the period, until 2 years of the periods. This money does not required for us. Then immediately the treasury department, they will start the investigation where the funds to be invested, So investment in the sense, either, as I mentioned, in case if the organization is ready to take the risk, in case if the organization, so now most of the organizations, they will think that, okay, now I do not want to take much risk, then I'm expecting decent return in a year. Then they will go and choose the money market instruments. So instrument is nothing but it's a kind of investment only. Okay, in the money market itself, we have a different financial instruments. Let's say, for example, fixed term deposit, then deposit at notice, then commercial paper, then facility. Sorry. So facility. So apart from this, even there are different, but here fixed term deposit. I think you might have heard about fixed deposit, where we are going to deposit into the bank. Okay, the money, if you have excess money, you are going to just depositing money into the bank. So deposit at notice. Sorry. So this is also, it's a similar to the fixed deposit, but something it is different than fixed term deposit at notice. So here the difference between fixed deposit and deposit at notice. So in fixed deposit, what we used to do, once we do the investment, I mean, once we deposit money into the bank, until 1 year, we will not get any interest. Then once every year, because if you are going to do the investment more than a year, then you will get the yearly interest. Then once the maturity will happen, the bank will return your principal amount along with the interest. But deposit at notice. So now the deposit at notice here, let's say now from January to September, the bank is offering a 6% of interest. But we'll discuss in detail about, okay, once we move there, but I'm just giving the background of this one. So now until I am going to give notice, okay, so there will be separate option. Okay, until to give my notice, then bank has to continue the same interest rate. Okay, so now as soon as once I give the notice, then it will get changed. Then even the system will ask you to change the interest rate and all, or investment amount also you can change. Then commercial paper, this is one of the financial instrument. In 1970s, this has been introduced in India. But most of the organizations, if you want to issue the commercial paper, or if you want to buy the commercial paper, only the SEBI or reputed organizations, based on their report only, we have to, I mean, either we are going to issue the commercial paper, or if you want to buy the commercial paper, then there is a separate criteria is available. Okay, if that criteria will be fulfilled, our organization, then organization will be eligible for that. Okay, but even this is a 1 year maximum, that the time duration would be 1 year in order to expire this commercial paper. Facility in nowadays, most of the organizations, even most of the companies are introducing this facility. I mean, even they are implementing this functionality. Again, in the facility, there will be two things. One is the bilateral facility. Another one will be a syndicate facility. First of all, what is the concept of facility? Because we understood fixed term deposit, deposit at notice, commercial paper we understood, but we'll discuss again in detail. Facility. I am just giving the background of money market instruments here. You might have heard in India. So nowadays, we are going to give credit for you. Okay, so now it's a facility. It's a kind of overdraft facility. Now, let's say now facility the bank has been offered the financial instrument has been offered 10 lakhs. So based on your credit score, based on your payment history, they are going to offer, let's assume, is it 10 lakhs rupees. So from that 10 lakhs rupees, if you can utilize whatever the amount you are utilizing, only for that only you need to make the interest, but rest does not required. Okay. So now this is one of the option. I mean, most of the cases in India, we will get the calls from Bajaj Finance and as well as Tata Capital. Then again, as I said, it's a syndicate facility is nothing but a one-to-one. Only Bajaj Finance is going to offer to you one-to-one. Then syndicate facility in the sense multiple financial institutions are pooling as a one institute. Okay, so you are getting the credit amount or overdraft facility from the multiple sources or multiple financial institutions. Then you are the one person, who is going to utilizing the credit amount, only one person will be there. But the service provider, the vendor will be multiple people will be there, multiple vendors will be there, but we'll discuss in detail. Okay, this is just the organizations are going to implement this one. Even this, only few organizations, only 10% organizations are going commercial paper. Even that is the reason I am keep on telling, try to watch the Economic Times and as well as some Money Control. Okay, so that you will come to know some organizations are issuing the commercial paper, some organizations are issuing the public equity. Okay, so you might have heard such kind of news. So now it's a 10% organizations only going with this functionality, but even only for one client only I have implemented until now, but this is the 4th implementation for me. But rest organizations, this is a quite common. But let's see. So as I have explained, the money market instruments can be used for the short-term investment or mid-term, or it's by borrowings also, which we can use. So these are the product types. See, these are the product type which are available. These are the important product types which you need to know. If I go and see here, there are n number of product types are available. Okay. System. Financial supply chain management, treasury and risk management, transaction manager, money market. If you see product types, fixed term deposit, either you can use for the deposit or borrowings, 51A or 510. Say fixed term deposit, the product category, deposit at notice, commercial paper, cash flow transactions, okay, interest rate instruments. Then anyhow, I have already given here is the deposit, okay, commercial paper. This is also one of the interest rate instrument. I'll put this one also. Interest rate instrument. Okay, so I'm going to remove this one. Commercial paper does not require. Then let us discuss about this, because 99% of the organizations are going to implement these product types from the money market. Okay, based on my past experience only, I'm just keeping here. Okay, others, if you can see here, there are n number of product types. You can see the facility, bilateral facility, syndicate facility. Okay, then fiduciary deposit and all, this is not required. Okay, let us discuss here. Now, let me. Okay, still, if anyone would require any clarification, so please let me know. Otherwise, I am going to basic terminology we have already discussed about, because I'm just copying from
Which kind of organizations use this money market functionality, Vijay?
see, any organization, there is no specific. There is no specific thing. Okay, either they can
Even
use any.
manufacturing organizations also will use?
Yes, yes,
Okay.
because see, there is no specific rule, right? We have to use this, because see, one thing, that is what I mentioned. If the organization is ready to take, if organization is ready to take risk, then they can go for even not only money market, they can go for the equities, securities, derivatives also. Okay, it's a
Okay.
depends on the, it's a depends on the organization to organization. That is what I'm telling from the beginning. Okay, it's a depends on the organization.
Okay.
Okay, I mean, we are not going to say anything, and it's a depends on the. Yes, I'm just copying from the existing batch content here. Okay, fine. Now, this I have already explained. Okay, so these are the product types, what we are going to do the configuration. As part of the cash management, so now let us think about the business scenario. Please concentrate from here. So now let us think about, as per the cash management. Okay, as part of the cash management, the cash manager has been identified that there are excess funds in the organization. Then the cash manager will call the AP team. Okay, how long the idle funds does not require for payment. Okay, how long the idle funds does not require, I mean, does not require, meaning that they do not want to use those funds. Okay, until, so okay, the funds does not needed for until 1 year of time. Then immediately, I mean, this is what the in real time the organization, in the organization, it is going to happen. Okay, so the cash manager will discuss with the treasury department and will take a decision to investment the money. Okay, let's assume the excess funds they have identified, it's 10 lakhs. Let us assume this is the amount what they have identified. Remember, note, I just forgot one thing. Please note here. When I mentioned is a excess funds, the excess funds are not from your reserves and surplus. Please note. Okay, the excess funds based on your organization profits. Okay, so then only you need to consider that as a excess funds. Remember, not from the excess funds, the excess funds from the organization organization's profits, and do not consider your reserves and surplus. Do not consider organization reserves and surplus. Reserves and surplus. Okay, this has the reserves and surplus, meaning that in case if organization will have some critical situations, then they can use some reserves and reserves and surplus. Okay, based on the organization security purpose or safety purpose, they are going to reserve some funds. Okay, that we should not consider that fund as a excess funds. Remember, based on the your current day statement, based on your prior day statement only, then you need to understand that, okay, now these are the excess funds which I could able to do the investments. Okay, until 1 year of the period does not required those funds. Remember, then only you can go and invest. Okay, but do not even in the implementation project also. Okay, you can suggest this one, but I anyhow the business no. Okay, they are well aware, but I'm just giving hint here also. Then now, okay, so now here there are two scenarios what I have explained here. See, there are two scenarios what I have explained here. The way of risk and reward, if I can say risk and reward. Yeah, the simple terminology, if I could say. If the management do not want, okay, let us assume before going to pitch into this topic, we have a 10 lakh excess funds in our organization. Then how to utilize these 10 lakhs funds and how can we do the investment in which financial instrument we need to do the investment. Okay, so now just keep in mind we have identified the 10 lakhs rupees is the excess amount. Now here, if you can see here, the investment opportunities here. Here we have the two kind of investment opportunities. The number one is if the management will think that I do not want to take much risk and they are expecting some decent return on the investment, on their investment. Okay, so now if this is the case, the amount 10 lakh rupees what they are having, they are expecting per yearly return is a 12% of the return on their investment. You can imagine, only I took example 10 lakhs here. You can imagine the organization will have the funds millions of millions of rupees. Okay, so they are expecting return 12% per annum. So they just go and deposit the money into the bank as a fixed term deposit. Then once in a year, they will get the interest. Then at the time of maturity, they will get the principal amount along with the interest. So here, do you feel that any risk here? In case if the bank will go bankruptcy, until then, the funds, our funds will be safe. Okay. So now in India, I think if you remember last 2-3 years back, okay. Now Yes Bank, there was one of the big issue. Then another one was it's a ING. Sorry, there was a one. I mean, last 2018-17 in between the period also. Okay, so there were multiple issues were going on. Okay, at that point of time, then only we are not expecting the full amount from the bank. Okay. Now, otherwise, 99% our funds will be safe. In case if the bank will go for the bankruptcy or the bank, I mean, the financial institution is not able to make the payments. Then here, the important thing here, what we need to understand, the investment is a safe here. 99%. Okay, the investment is a safe and we are expecting decent return. Now, moving to the second one, the opportunity to here. If the management want to take more risk and they are expecting return would be 30%, let us assume. So this is the decent return, okay, without risk. But now organization is thinking that, no, I do not want the 12% rent, 12% or 10%, whatever it may be. That is not sufficient for me. then I am expecting return on my investment yearly. Remember, these the mentioned what I have mentioned, it's a yearly based. Okay, so yearly I am expecting 30% return, or even monthly also. Okay, some organizations may go for the return per year. Okay, I'll mention here yearly return. Now, if this could be the case where you are going to invest your funds, and what are the ways are available, and what are the opportunities are available, if I invest this money, is there any guarantee? Because I'm going to take a risk, much risk here, high risk and high return is there here. So now let's assume the organization would like to invest into the commodities or equities or mutual funds, okay, or some bonds. There are different sources are available. So even bonds also, even yield bonds, there are different kind of bonds are available. So those are also will not give much return, maximum 8 to 9% will give. So let's assume the organization has been decided that they would like to do the investment into the equity. Remember, then here, so the organization is decided that they want to do for the, investment in equity. So now let's assume equity is nothing but your shares. Don't confuse. Equity, I'll put it is a shares. I'll put it. So let us assume. So today the share price, let us assume we have entered into a contract or we bought the shares. Let us assume yesterday each share is 100 rupees. Okay, each share value. This is the, let's say, the purchase buy price. Then 10 lakhs divided by, okay, we have how much we have, the funds we have. We want the investment amount. Investment amount is, let's say we have the 10 lakhs. 10 lakhs here. Let us assume how much quantity we are going to buy. Okay, 10 lakhs divided by 100. Let us assume. So now we will get the 10,000 shares. Okay, this is the quantity of shares what we are getting, quantity of the shares. Now understand here, today the price is 100 rupees. We have entered or we have purchased. Due to some XYZ reason, in upcoming 6 months, this price may go 50 or may go 10 rupees also, due to some XYZ reasons. I'm not exactly telling the reasons. Due to some market conditions or due to some financial background of this organization, is there any guarantee? So now we have invested is 100 rupees. Now tomorrow, maybe down the line after 6 months, it may go 60 rupees. So the amount is 10 lakh rupees. The amount is 10 lakhs rupees what we have invested. But what is the, now you can see, okay. So now it's now you can see it's 10 lakh rupees amount is invested, but we will have the shares is 10 lakh, 10,000 only, 10,000. But here, what is the loss here? Now you can see here 10 lakhs divided by 60. So now, 10 lakhs, okay, 10 lakhs divided by 60 only. So 66, not this one. 10 lakhs. Okay, sorry. What is the current price? Okay, sorry. I'm just confusing into 60. So now you can see here the current price. This is the at the time of buy. This is the current price. Current price. You can imagine here. Now, 10 lakhs rupees amount we have invested. Now the today price is a 6 lakhs rupees only. What is the loss here? You are booking the 40% loss here. It's a huge loss. So if you want to mitigate the risk, if you want to control the risk, that is the reason. So here loss is a 40% for us. If organizations will be there in this situation, they need to take a decision whether we want to continue this position or we want to exit the position. But 99.9% the organizations does not exit this position, even though they will not do this strike these investments. Okay, if they place the order buy order, equity, they must enter into either futures or options. Okay, future and options, they will enter into the derivatives, opposite contract of this one, so that they will control, they will mitigate their risk. Okay, that another topic, then we will discuss about that one. You can see here what we need to understand here. We have two kind of opportunities to investment into the market. That is clear for us. Number one is I'm expecting decent return. Number two is risk and reward. If I'm going to take much risk, for this one, there is no guarantee here. The option number two, there is no guarantee here. Can we give guarantee either market go up, either this 100 rupees, this stock price may go up, may go down? Is there any guarantee? Absolutely no. Only God only knows about this one. So that is the reason. Then if you take the much risk, then you are going to expecting the same way return. Okay, see, now today is 100 rupees is there. Then maybe after 6 months period, then if it go at least 130 rupees, then that's a well and good. It's a positive direction. If it is goes minus direction, then only it will create problem. So here we need to understand two things. Before going to do the investment, we have to do the analysis. In which instrument we need to do the investment? Based on the analysis, forecast analysis, based on the past dated transactions data, market data, and as well as future upcoming events, based on the analysis only, the organization is going to take a decision. If we do the investment in so and so stock, then we may get some decent return. So we are expecting the return. So again, to do the analysis, we have a different kind of sources are there. Okay, again, we need to get data from the third party organizations. Okay, now if you remember JP Morgan and as well as Morgan Stanley, they are pure analysis based only. Okay, pure analysis based. So today price is this much, then in the down the line after 1 year, what would be the price? What would be the organization profit and losses? They are going to estimate. Okay, based on that only, the organization is going to take a decision. Okay, now what we understood, there are two types of investments here. Now we are going to do the organization, our organization has been decided that then they would like to go for the fixed term deposit. Okay, fixed term deposit in the sense they are expecting the decent return, and it's a 12% interest is fine for them, or 12%, 10%, whatever it may be. Okay, but decent return. They do not want to take much risk here. Like this, they do not want to go like this. Okay. So now here, is it clear for you the two types of investments? Then I'm going to start how the product type to be created in the system. Okay, these two are important for you. These are the basic things before going to start the basic topics.
Clear, Bhaskar.
Okay, fine, no problem. Yeah, thank you, Anand. Now, see, now you can see here, I just mentioned the same point here. Now the management has concluded based on the two opportunities here. Based on the two opportunities, they want to go with money market instruments like fixed deposit or deposit at notice, okay, as well as facility, whatever it may be. Then the treasury department, then immediately what they will do, the treasury department will call to treasury consultant. See, now our role will come into picture. Remember from here, that is what especially I mentioned this word here. Immediately the treasury department, now business people will call to TRM consultant. We have decided that we would like to do the investment into the fixed term deposit. Please do the respective configuration for the fixed term deposit product type entire cycle. I mean entire cycle in the sense you need to buy the order and you need to do the payment on behalf of that order. Then there are different activities which are going. Okay, so we have discussed about, right, front office, back office, accounting. Okay, whatever the options we have discussed, so we have to perform all those activities. I want to buy the order, then I want to pay the money. I mean, organization need to make the payment to the counterparty. Then again, we need to perform every monthly accrual and deferral. And at the same time, once in a year, we need to get interest from the financial institution and also the maturity entry. So we have to do the configuration for all these activities. Okay, but that is the part of configuration. We'll see that one. Now, please concentrate here. This, if you understand here, this structure, what I have explained here, then this is important for you. Okay. So now, so this will give entire picture for you. If you understand well here, then definitely you will, I mean, you can understand other instruments, even other components also. Now, the TRM consultant, before do the configuration in the system, need to understand the structure of the product. Remember. So now we have an excess fund. So point number one, first you can see the product type, transaction type, condition type, flow type, correspondence. The heads what I have given here. Then here you can see we have a funds, excess funds is at 10 lakhs rupees which are available, which we have already discussed. Then the management has been decided that they want to go for the fixed term deposit, FD, fixed deposit. They want to do the invest into the fixed deposit. Remember here, excess funds, we are investing the funds. Then now, what is the transaction type? Now, how you can differentiate between buy and sell? Two transaction types are there. While creation of the deal itself, we need to differentiate this one. Either it's a buy transaction or it's a sell transaction. So now the simple thing here is that the buy transaction is a buy transaction type. Buy transaction type is 100. Then sell transaction type. Sell transaction type is 200. You can differentiate with this. Either it's a buy or sell. But most of the cases, 99%, we are going to use these two transaction types only. If you have excess funds for investment, you can use the transaction type 100. If you are borrowing money from the market, you can use the 200. At the time of placing the order, we need to differentiate this one. We will see that one. That is what I have mentioned here is the transaction type is 100 because the product type need to associate with the transaction type. You can see here transaction types here. You can see 100 is an investment, 200 is a borrowing. With the premium and all, this and all also it will be happen, but since the rare cases, 99% either we can use 100 and 200 only, but premium, it's a rare cases. Even I don't see that one. This 210, I mean 101 and 201 cases. Okay, then now we have the transaction type. Now coming to the condition type. On my investments, now I have decided that the 10 lakhs rupees which I am going to do investment into the product type as a fixed deposit. Now, in the fixed deposit, after doing investment, I'm expecting the return as a interest. I'm expecting the return. In order to derive the interest for your transaction, we have to define the conditions for our product type. Then, now, in case the maturity, okay, interest, it is a yearly based, okay, so yearly based, or it's a even monthly, even yearly, monthly, daily also, there is an option is available. Whichever you want, you can select it. But at the time of deal creation, I will show you how to select this option for interest. Then again, the final repayment on maturity. Okay, now let's assume we have done the investment for 2 years, up to 2 years, or up to 1 year. Once the 1 year will be over, then the bank has to return to our investment along with the interest. Then flow types. Flow type is nothing but the money is incoming or outgoing, simple thing, or it's a investment increases. The thing is that here, if you do the investment, the money will go out, your investment will get increase here. So investment account will be debit, your bank account will be credit here. Then in case in between the position, okay, after 6 months period, you have decided that you want to do that, you want to increase your investment, then obviously you can go and increase the investment amount. Then the next one is the correspondence. Correspondence is nothing but your letters. I mean, just for the, it's a PDF format. So the standard SAP delivered one. So we have to do the configuration for this one also. Then only based on the product type, based on the transaction type of combinations, we have to do configuration for the correspondence. Again, the correspondence to be for internal management purpose, or it should be sent to your head office. Okay, there will be 2 options are available. Which one you want, you can select. Based on that, the system will generate the correspondences. But again, this correspondence just for your internal reference purpose only. Then or else if you want to send this to your counterparty also, again you have to do the separate configuration. But generation, what is the configuration and all, I will show you, and how to generate these correspondences, I will show you. While creation of deal itself, we can see that one. Okay, is it clear for you? How the structure, how we have to understand the product. This is the structure of the product. Okay. If anyone is have any further queries, so please let me know here about this one, because this is the basic. That is what I'm repeating and again.
What is flow type, Vijay? So the transaction type itself will determine, right, whether it is an
investment or borrowing. The transaction type will decide. Okay,
yeah.
based on the transaction type, we need to understand. The flow type is nothing but either money incoming or money outgoing. The simple logic. Okay. So now you either inflow or outflow. The flow types will be differentiate your business transactions based on your transaction types. Okay. If it is 100, then you are doing investment. Investment in the sense this money has to, we need to transfer to bank, then investment account will get increase, then our bank account will get credit here, right? The flow type, either
Yeah.
inflow or outflow.
Okay.
And
Okay,
Vijay,
fine.
these transactions will flow to analyzer as well, right? Cash flow analyzer.
This one, the flow, yes.
Yep.
Yes, based on the transaction type only, you need to do the cash flow analyzer mapping. Based on the product type, based on the transaction type one only, based on this combination, we need to do configuration for your analyzer.
And flow type only used for whether investment increase or decrease, and withdrawal or something. Is my understanding correct?
Yes. See, the flow type will be determined automatically. Okay, see now, as soon as once you place the order, once you create the deal inside of that one, the flow types will be decided. Okay, the flow types will be determined automatically. Okay, no manual intervention to be required. Until and unless if there are any derived flows, then if you want to key manually, then that is fine. Otherwise, the system will, the generic scenario here, the system will determine flow types, your flow types. So no manual intervention to be required here. In case if there are any derived flows, then we have to key them as a manually. That is what I mentioned here. See now here, because the derived flows can be defined with respective of the main flows. Okay, now if it is investment, now let's assume you want to charge some withholding tax on behalf of this investment on the interest. Let's assume, or else you want to pay some charges, some bank charges. Bank charges in the sense not the because of the EBS, not the payment, some stamp duty kind of thing. Then you want to apply those transactions on behalf of this particular transaction. You need to do the derived flows configuration, because I mentioned here that derived flows can be defined with respective to the main flows, because the main flow here is my investment amount. On this amount, I am going to derive, either it could be a percentage based or it could be a fixed amount. Okay, derive that one.
And based on the organization only, we can identify, right, whether it's a 100 or 200. Like you're working in a manufacturing organization, right? So you're investing somewhere in the banks or any places. It's investment, right? Transaction type 100. Let's assume
Yes.
you're working in a JP Morgan. Okay, you're taking the investment from the customers. Then it would be the 200.
No, not like that. Not like that. See, the simple logic here, if you have the, see, if our organization have the, see, the JP Morgan Stanley, I mentioned that those are the analysis organizations. Okay, they are not the investors. Okay, they will give advice to us, to our organization. Today the price is 100 rupees. It may go 150 rupees or 200 rupees in upcoming 6 months of the period, or in upcoming 1 year period. Then they will give advice. Either you can do the investment or you do not do. That is up to you. But the thing here is that if you have the excess funds, you can do the invest. Okay, so on this one, you can expect the return. Sell in the sense, here sell transaction, you do not have excess funds. You want to borrow the money from the market. See, now you have sufficient funds here, so that is the reason. Okay, then you are investing more than budgeted amount here. now here you do not have, first of all, to run your business organization. Day-to-day it could be a day-to-day operations, or it could be some payables. Okay. So you do not have, first of all, sufficient funds in your organization. If that is the case, you are asking, I mean, or else you are borrowing money from the market, from the different sources. Then you need to consider this one this is a liability, this is an asset for you. You have to repay this one once the maturity will happen. This is the buy. The bank will repay the money. Is it clear? Simple logic. This is the buy. If you have excess funds, you can go with this one. If you do not have excess funds, you want to borrow money from the market. You want to pool funds from the market based on the different kind of financial instruments. Okay, either you can go by which one, either fixed term deposit, deposit notice, commercial paper, facility, whichever you want. Which one is feasible for you, you can go. But the intention here is that the sell transaction, the transaction type of 200 is you want to pool funds from the market. It is a liability for you. This is the asset for you. Remember, it is an asset. It is a liability for us, for our organization. Asset means we are investing, we are getting the return. Liability, we are borrowing money from the market, then we have to repay that amount. Is it clear?
Yeah, clear. Yes.
Yeah, maybe you can also include on buy. You can say 100 is for invest, 200 is for borrow.
Yes,
maybe
yes,
you can
yes.
put it in brackets. Yeah, I can just put it in brackets.
Yes. Here I have already put 100 is a buy and sell. Okay, that is a buy and sell. I have already updated. Yeah. Then now derived flows. Okay, as I have mentioned, how the derived flows will be configured in the system. We'll see that one. Okay. Then this is also one of the interview question, how the derived flows will be configured and what is mean by the derived flows. First of all, they will ask like this, what is mean by derived flows? Okay, but we'll see the configuration, how the configuration is to be done. Then now about the general valuation class need to be explained. Okay, fine. So now we have seen about the derived flows. Now moving to the general valuation class. So the general valuation class, which is going to differentiate what kind of investment will be. Either it could be a short-term investment, mid-term investment, or long-term investment. Okay, or it could be some swapping kind of thing. Okay, so we need to differentiate at general valuation class. So the general valuation class configuration, it's a mandatory. Without this one, see now assign general valuation class to the money market transactions. If you can see here, you can see here short-term investment. So now I'm going here. You can see short-term investment, mid-term, long-term liabilities, then long-term investment, non-current. So now you can see there are the general valuation class, which is going to differentiate the types of investments. See, investment in shares, investment in term deposit, investment. Somebody has created this one. It's not the up to 91 is a standard one. Okay, this somebody has created their own. Now you can see here. So it is going to differentiate what kind of investment, either it's short term or mid term or long term. Then now the important thing here is that the next one is that this is also the general valuation class, also one of the interview question. Then second thing is that the PMP, position management procedures. This is a very important one. In simple way, they will ask you in the interview, can you explain about what is meant by PMP and how it will be used for your product valuation? PMP stands for position management procedures. So this will be represent how the product has been evaluated and what is the current status of the position. So basically the position management procedure, which is going to used for how the position being evaluated. Position being evaluated in the sense, I have a deal. I have done the investment into Forex. Let us assume. So the Forex, either it could be a spot rate, the valuation has been done with a spot rate, or it could be a forward rate. So today is the price is, let's say 83 rupees, 1 USD is equal to INR 83 rupees, which is running. So in future, it could be, let's say, the 85 rupees. Okay, how the differentiate? Anyhow, we are going to post accrual different, but while seeing PMP, position management itself, we need to understand, okay, the system will give the view how the position is being evaluated if the still position is open. Even you can view the product which you have already closed in the sense the maturity has been over, then the deal, it is already been closed. Even such kind of products also, you can go and view your position. You can view what is the current position of this the deal, and what was the investment, and how the product has been evaluated, which is give overview of how the evaluation has been happened. This is the one important thing. Okay, now, so this is the use of the, but after doing configuration, once, I mean, position PMP also we have to do, we would require to do the configuration PMP also. Then only, I mean, otherwise it will, the common error, okay, it will throw. Coming to the account assignment reference. So the account assignment reference, which is going to used for to determine the GL account. First thing is that even in treasury transactions, for treasury also, we are not going to specifying any GL account in the front end. System need to determine the GL accounts from the back end. I do not want to, even first of all, there is no option to key the GL account. This GL account should be debit, this GL account should be credit. There is no option. But what is the source in order to determine the GL accounts? Account assignment reference will play the key role. This account assignment reference, we need to do the configuration in the system based on the, even there are two options are available. One is a constant in the sense, one for one product type, you can use one account assignment reference, or one account assignment reference you can use for the multiple product types. Then again, this is a configuration activity we have to do in the system. Okay, so the account assignment reference can be used for the determine the GL accounts. Okay, I just mentioned here just for our, I mean, this is nothing to do, but values for previous batch. Okay, I did the configuration. Then the account assignment reference will be created and assigned to the below combinations. Okay, so now here money market product type, what we are going to do the configuration here. So now let us see, for our purpose, ZFD, okay, Z fixed term deposit, which we are going to do the configuration in the system, or else FD, we can directly, instead of we can go FD also, but let us go with the ZFD, okay, for understanding. So the valuation area about we have discussed in the yesterday session. Okay, so the valuation areas, there are different valuation areas are available. Either you want to evaluate for local valuation or GAAP or IFRS purpose, and where the relation to be mapped. This we have already discussed in the yesterday session. Okay, so up to now, I have explained in detail about here. Yes.
Quick question. On your account assignment reference, are you not supposed also to put in transaction type?
See,
Or it's not
The
necessary.
transaction, no, see, the transaction type also it is necessary. Okay, but now here I have mentioned, okay, transaction type will be always associated with the product type. Okay, without that system will not understand. Okay, this is a mandatory one. Okay. See, that is what the most of the things I have covered here. Okay, so wherever the important things need to be described here, those are the things only I have explained here. Because position management procedures, general valuation class, these are not available in this explanation here. So I have explained here. Okay, still anyone? Okay. So now tomorrow what I will do? I will start the configuration from tomorrow. Okay. So before then, now here is the account determination process. Okay, this and all accounting entries. Now, okay, tomorrow I am going to start the configuration. Then once the configuration will be completed, then I'll go and explain what are the accounting entries will get flow. Okay, how the accounting entries will be flow. Okay, now exactly what I'm going to explain the accounting entries. These entries the system has to post. We have to generate this accounting entries. But before generation of this one, there is a lot of configuration is to be required for this one. Okay, we'll do that configuration from tomorrow. So if you have any further queries, so please come back tomorrow so that we'll discuss. Okay, yeah, thank you. Thank you and see you tomorrow.
Thank you.
Yeah,
Thank
thank you.
Thank you.
Thank
Yeah.
you.